Japan's April trade data landed on May 21st. Exports surged, +10% year-over-year. The forecast was +10%. That's not a beat, that's a different story entirely.
While every analyst in Trunkstores has been writing about US tariffs gutting Japanese automakers, and every headline screamed about the Middle East oil shock squeezing Japanese manufacturers, Japan's actual export machine just delivered its best performance in 15 months, and the engine driving it isn't cars, it's the invisible infrastructure of the global arms race.
The Ministry of Finance released Japan's April trade statistics on May 21st, and the numbers stopped people mid-sentence. Total exports up 17% year-over-year in yen terms. Analysts polled by Reuters had expected 10%. The trade balance narrowed to sombre 10 billion, roughly 10 billion.
But the headline figure isn't the story. The story is what's inside it. Semiconductor-related shipments rose 60% year-over-year, not 60% from a depressed base, from already elevated will levels that followed Japan's previous chip export record. Chip equipment exports to China jumped 60% to the United States, up 9%. Japan's semiconductor machinery was going everywhere, to everyone simultaneously.
At the same time, Kioxia, Japan's NANU, the flash memory giant spun out of Toshiba in Nisen Sivihash, reported forecasting a 48-fold increase in quarterly net profit for the April to June period. The number hat 6 rok shruk nuke an billion, which converts to roughly go billion in 1 quarter. For context, that is more profit than most Japanese industrial companies generate in an entire decade.
Kioxia's full fiscal year ending March RCNU showed revenue of 1,100 trillion, up 37%, operating profit of 870 billion, up 92.7%, and net profit of 554.5 billion, up 130.6%.
3 years ago, Kioxia nearly collapsed in a NERD glut. Western Digital tried to merge with it and the deal fell apart. The company was written off as a commodity player in a market everyone assumed China would commoditize into irrelevance. Now it is printing the largest profit figures in its history.
So what changed? To understand what just happened, you have to understand Japan's actual position in the global semiconductor supply chain, because it is almost nothing like what the financial press describes.
The popular version of the semiconductor race goes like this. NBUIDIA designs chips, TSMC fabricates them in Taiwan, and Samsung competes in memory. Japan doesn't appear in that story except as an also-ran.
The accurate version is different. Japan does not make the AI chips. Japan makes the only equipment that can make the AI chips.
Tokyo Electron, which we covered in episode Sorshi, manufactures the deposition and etch equipment used in virtually every advanced logic chip on Earth. Lasertech makes the only inspection tools capable of validating EUV photomasks for 3 nanometer and below processes. Screen Holdings and Dainippon Screen make the wafer cleaning systems that run inside every TSMC, Samsung, and Intel fab on the planet. And Shin Etsu Chemical, which controls roughly 100% of global silicon wafer supply, provides the substrate on which everything else runs.
This is what analysts mean when they call Japan's position upstream. It is not a geographic metaphor. It is a structural description. Every nation building AI data centers, the United States, China, South Korea, Germany, India, must pass through Japanese supply chains to do it. They cannot buy their way around it. They cannot build their way around it quickly. The capital costs and engineering expertise accumulated over 40 years at these companies represent a moat that has no near-term substitute.
When global AI infrastructure spending accelerates, Japan wins. Not in the way that NBUIDI wins. not in headline earnings per share, in the quieter, less visible way that happens when every factory building advanced chips needs to buy more Japanese equipment to expand capacity.
That's what the April trade data is measuring. The Yonju Iten Lokpa surge in semiconductor shipments is not a single company story. It is a system-level signal that global chip capacity expansion is running faster than expected, and Japan as the upstream supplier to that expansion is capturing that demand regardless of what tariffs are doing to Toyota's export profits.
According to Oxford Economics Asia Chip Export Index for May, new for ZRZ, the gap between value and volume in Asian chip-related exports is at a historical high. In plain English, the prices for Japanese semiconductor equipment and materials are rising faster than the volumes. Japan's suppliers have pricing power right now. That is the definition of a structural advantage.
Here is the part that takes this from an interesting data point to a genuine inflection story. On the same day the trade data was released, May 21st, Bank of Japan board member Junko Koeda gave a speech in Fukuoka. The headline, "It is reasonable for the bank to raise the policy interest rate at an appropriate pace to address high inflation."
This is notable for several reasons. First, it came against a backdrop of apparently softening inflation. Japan's core CPI, which strips out fresh food, came in at 8.1% for April, a 4-year low. If you were just watching the headline number, you would assume the BOJ was getting relief, not contemplating tighter policy.
But the BOJ isn't watching the headline number in isolation. The GDP deflator, the broadest measure of economy-wide price pressure, came in at 17% for the first quarter of Nisen That is the structural inflation signal. The headline CPI is being suppressed by government energy subsidies that were extended in response to the Middle East oil shock. Strip those out and Japan's underlying price environment remains substantially above target.
Japan's Q1 GDP, released on May 19th, grew at an annualized rate of 2.1%. Beating the 8.7% forecast. The Japanese economy is expanding faster than expected, in the face of global uncertainty, precisely because of the structural demand for its upstream semiconductor position.
The April 28th BOJ rate decision was a hold, but the vote was 6-3, unusually divided for a central bank that typically moves by consensus. Reuters polled economists and found 60% expect a rate hike to 8.0% at the June 16th meeting. If that happens, it will be the highest BOJ policy rate since 1994.
Think about what this means in context. For 30 years, Japan tried to create inflation and failed. The deflation trap, the lost decade, the zero interest rate policy, these became the template for every central bank studying how not to become Japan. Now Japan is raising rates into a global uncertainty shock because its economy is structurally strong enough to absorb tighter monetary policy. The inflation it spent 3 decades trying to manufacture has arrived, and this time the BOJ is treating it as a signal to normalize, not a reason to panic.
The dominant narrative in new wire work goes like this: Japan is exposed. Tariffs from Washington are eating into Toyota's margins. The oil shock from the Strait of Hormuz crisis is raising energy costs for a country that imports nearly all of its fossil fuels. The yen is volatile. The export economy is at risk.
That narrative is not wrong about the risks. Toyota did report that tariffs erased $1 billion in operating profit. As we covered in episode Sandy Sindane, Japan does import roughly 20% of its energy. These are real vulnerabilities.
But the narrative misses something important. Japan's economy is not a monolith. While the tariff pain falls on automakers, the infrastructure buildout is creating record demand for an entirely different part of Japanese industry, the semiconductor equipment and materials companies that supply the global chip expansion regardless of trade friction.
This is the Japan factor that rarely shows up in Western financial media. Japan's competitive position is not in finished goods that cross borders and face tariffs. It is increasingly in intermediate goods and capital equipment, the components and machines that sit 2 or 3 steps upstream in the global supply chain, where no one puts a tariff because no one else makes them.
Kioxia's 48-fold profit surge is the most dramatic version of this story. A company nearly killed by a commodity bust in 1 sen yu sen is now generating more quarterly profit than Japan's entire steel industry in a good year, because AE requires massive NE storage, and Kioxia is one of the only companies in the world with the capacity to supply it at scale. The company is planning a U.S. depositary receipt listing and expanding its partnership with NBUI on AE memory. The near bankruptcy is a footnote now.
The BOJ signaling a rate hike into this environment is not a contradiction, it is a confirmation. When a central bank that spent 3 decades in emergency accommodation mode begins normalizing policy, it is saying this economy is strong enough to stand up.
Japan's April trade data agrees. The question for the next 6 months is whether the AI infrastructure spending cycle has legs, and whether Japan's upstream position can offset the continued headwinds in auto and energy. The June 16th BOJ meeting will tell us something important. So will Toyota's next earnings call.
What we know today from the numbers that landed on May 21st is that the story of Japan as a tariff victim is missing half the picture. The other half is a country sitting at the center of the global AI buildout, quietly shipping the machines that build the future. Word count sen punpui kush patch words estimated duration punpui panist format news flash